Hello and welcome to the Quality Investor. On here, I like to talk about my passion for investing in stocks, investing principles, and much more. This is a community that likes to keep it simple. We buy great businesses, and ideally, we hold them forever. We don't worry about day-to-day price fluctuations, but we do like the periods where the market is down because that drags good businesses along with it and allows us to buy them at a lovely discount. We focus on the fundamentals of the business and we do our best to understand what the future economics of the business may look like. Today, we're discussing a veritable cash printing machine, Visa, ticker symbol V. Visa is almost the perfect business. Every time an individual swipes their card, credit or debit, Visa takes a small percentage of that transaction and calls it a day. Their margins certainly reflect their almost no-cost system. It's a great business, so let's dive in. Please, if you haven't done so, hit that like button for this amazing video and subscribe to the channel. It really helps us out and it lets me know that you want to be a part of this community of quality investors. Also hit that notification bell so you can get notified as soon as I post more great content just like this. All right, let's dive in. Visa's business overview seems simple on the surface, but there's a lot going on here. So their core business, of course, is consumer payments, where, the credit and debit card, tap to pay, things like that. And they're also focused on really adding the amount of transactions they can perform in a year through various types of transactions that done. They call that new flows. So you have their person to person, business to consumer, business to business, and so on. They also have a small business here, value added services, which is similar to like a consulting business. You see, Visa has a lot of proprietary information with their payment network. And because of that, they can offer a lot of insight, both economic and how consumers spend their money. So you have, risk identity solutions and acceptance solutions issuing and so on, advisory services. So Visa has a very large way of diversifying their revenue stream, and they're continuing to grow the amount of cash transactions that are currently done in the world over to card transactions, which will further enable Visa to grow. Just for a quick tidbit, there was $18 trillion worth of card transactions last year, yet that is small potatoes compared to the amount of cash transactions still done in the world today. What does the Visa revenue breakout actually look like? Well, if we look at this chart here, we see they have service revenues and data processing revenues are their two largest segments here. And service revenues are the services that Visa charges to banks to allow the banks to issue a card under Visa's name. So whenever you get a card from the bank and it has Visa, the bank has partnered with Visa in order to allow that card to have Visa's brand on it, and therefore has access to Visa's network, which is going to enable Visa to then collect their data processing revenue. And the data processing revenue is basically the networks that Visa owns, called VisaNet. Whenever there's a transaction, they take a small fee of that transaction, and that's their data processing revenue. It's important to understand that because Visa is not a lending business. They don't lend money to their customers. They don't charge or set interest rates on the credit cards. All they really do is simply collect a fee for simply accessing their network, VisaNet, to allow these seamless movement of transactions. The other interesting thing to note here is this contra revenue account, client incentives, $10.3 billion. So they make $39.6 billion in the last fiscal year, almost $40 billion. And subtract $10.3 billion from that and you get that $29.3 in net revenues. Now, what is that client incentives? So when you have a credit card from your bank, you get those great points, airline miles, and so on. Because their margins are so high, they can offer these incentives to consumers to entice them to get their branded products. And that's really what is the biggest benefit of credit card usage is when you swipe that credit card, you get those points from Visa, and as long as you pay that credit card off on a monthly basis, you're really not going to have any sort of debt issues with your own consumer spending. But you still get that benefit of the points. So those transaction fees, and when Visa raises that processing fee on their data processing network, that's what enables us consumers to benefit with our credit card spending. And sometimes whenever Visa does raise a fee, and I'll touch on this in a minute, that you have that political issue of raising the fees. And of course, really the large retailers are who complain the loudest, and really when Visa raises those fees, the consumer benefits the most because that allows us to get more credit card benefits. So what's Visa growth like in the future? Well, if we look at this chart here, we can see that this is the world's top 20 countries relying on cash in 2022. And you can see a percentage of people with internet access and a percentage of people with credit card owners. You can see there's a lot of population in this world that still uses cash only. The big one, in my view, is India. Over 1 billion people in that country, 3% of them have credit cards. There's a lot of growth potential there for Visa and MasterCard, which in my view is another great company, to really capture that cash to card conversion and allow Visa to continually grow their revenues far out into the future. So you can see here that when Visa and MasterCard both announced their fee increase, going to happen, I think Visa's in October and MasterCard is next spring. That of course set off the alarm bells in Washington, D.C., and we have politicians, bipartisan apparently, that want to introduce legislation that prevents Visa and MasterCard from doing this in the future. Dick Durbin, I believe, and Roger Marshall reintroduced legislation targeting swipe fees last month, saying the news of the fees increase solidifies that it's time to pass our bipartisan bicameral legislation. They would argue would increase the legislation, of course, they argue, would increase competition and lower costs for business and consumers. However, I do agree with what this individual at the Electronic Payments Coalition said, that it actually tends to benefit the big box retailers like a Walmart or a Target. It says, however, the Electronic Payments Coalition, which includes Visa, MasterCard, and other banking giants, has argued that such legislation stands to benefit big box retailers and would eliminate funding for popular credit card points programs. And that's the key issue in my view. As consumers, we love those points programs and we want to continue using them. We have to allow these incremental increases every few years for Visa and MasterCard. And let's be honest here, I think a Walmart and a Target can handle it. Big box retailers led by Walmart and Target and their allies in Congress continue to distort the truth about interchange. Richard Hunt, the executive chairman of Electronic Payments Coalition, said, Hunt noted that swipe fees have largely remained stable in recent years, while retail sales have increased, and they really have increased if we look at some of the other companies out there. He also pointed to the failures of large-scale retailers to pass on those savings from previous legislation that targeted similar fees on debit card transactions. So basically he's saying that Walmart and Target and other big box retailers got similar legislation passed, but did not pass any of those savings onto us, the consumer. Lawmakers should not fall for the broken promises made by merchants. Okay, well, with all that stuff out of the way, let's dive into the Visa stock and see what the numbers look like, and see if we can understand if it's a buy right now. All right, so we're on our investment summary page here, and there's a few metrics that I like to just keep it high level here initially when we look into these various companies. So we have a PE ratio currently of 29, just a little bit below their 5 and 10 year average, so a bit of a discount right now. And a forward PE of 28. They are projected to grow slightly in this fiscal year and next fiscal year due to the general malaise out in the economy. However, we should see a lot faster growth as the decade continues on. Profitability-wise, and this is to me the best number here, 80% gross margin, amazing, and an operating margin of nearly 65%. It's actually a little bit below their 5 and 10 year averages, but as you'll see in a minute here, they're pretty stable. Their return on invested capital is absolutely incredible, 28.13%, well above their 5 and 10 year averages. And a return on capital employed, 28.97%, also well above their 5 and 10 year averages. They currently pay a dividend of $1.80. We should see a dividend increase possibly this week, and that brings us to a dividend yield of 0.78. So there's a very tiny yield. However, there's a lot of room for that dividend to grow in the future. If we look at their share price year to date, we're sitting at about a 10.71% return. And over the last 10 years, they've returned to shareholders capital appreciation of almost 17% per year. As we move on to our charts here, we can see they have a nice, great chart of continuous growth in revenue, profit, and net income. Their SG&A margin has decreased over the years. And like I said before, their operating margin has stayed relatively stable. And you can see as a function of expenses, their operating expense margin has actually decreased a little bit over the years. And they just have great earnings per share growth over the years. That dip here for the COVID year, but they're back on track after that. And they're also doing share buybacks, which is something I love personally. They've bought back shares almost every year for the last 10 years. So what is their projected income for the future here? So for the close out this fiscal year in 2023, I'm projecting a $32.5 billion in revenue, an increase of 11% over the prior year, a earnings per share of $8.22, an increase of nearly 18% over the prior year, and a free cash flow of $17.8 billion, which is a free cash flow conversion of $1.05 from net income into free cash flow, and a slight decrease over the prior year, and a very healthy margin there of 54.84%. Going forward for the next 10 years, we have growth in the revenue 10% in year 2 all the way through year 6 here, 8%, and then 8% going forward, giving us a 9.5% compounding annual growth rate. Net income, I'm projecting to grow slightly less at about 85% of what earnings per share grow. So earnings per share, it grows almost twice as much as what their revenue grows at. So we can see those projections reflected here, 17% in year 2, all the way through to year 6, where I have a 10% growth after year 6 through year 10. That gives us an earnings per share growth of 12.4% and a compound annual growth rate of net income of 10.47%. And you can see that aligns here nicely with what their historical averages are. And I do think it's even more conservative than what they've done historically. Free cash flow. So what I do for free cash flow estimates, I use a free cash flow conversion number, which is I'm estimating at about $1.09 of net income. So for every dollar of net income Visa earns, they convert about $1.09 of that to free cash flow. So that gives us a free cash flow growth rate of nearly 10% compound annual growth. And we can see very nice margins here that are just continually increasing up a little bit through 61% in year 10. So plugging those numbers into our discounted cash flow model, we can see here we use our free cash flow over the next 10 years, and we discount that back every single year to get our discounted model here. I'm using a discount of 8%, and once we discount our free cash flow at 8%, that gives us a current share price of $294.75. Coming over to our dividend discount model, we can see that, like I was saying earlier, Visa increases their dividend really well every single year, 21% per year over the last 10 years. They increased it 17% last year, 6% in 2021. I think that's a COVID-related issue. And I don't have any problem. They've already increased it 20% for this current dividend, and I don't see any reason why they won't continue to increase it at a very high clip. They only have a payout ratio of 20%, so they have more than enough free cash to cover their dividend. So I'm projecting 15% from 2024 through 2027 and a perpetual dividend growth rate of 7.5%. That gives us a dividend price of $436.03 per share. For our exit multiples, our peer comparison, I am using MasterCard, American Express, PayPal Holdings, and Fiserv as my comps. That gives us an average PE of 24.28, which comes out to $191.31 per share. Okay, so how does all those numbers come in and affect our valuation? All right, let's take a look here. So we do a reveal, our discounted cash flow, like I said, 294, 436 for the dividend, which of course we're going to include, and an exit multiple of 191.31. We're not including Graham's valuation model because it's not very applicable to a company like Visa. And our final valuation average comes to $277.84 per share. That's a 20% potential upside here. And with a margin of safety of 10%, and I do believe a 10% margin of safety for a company like Visa is reasonable, as they are a very stable company and have almost no costs on the cost of sold side to really destroy those margins that they have. That gives us an acceptable buy price of $250.06, which of course right now is a buy when you take into consideration that the current share price is at $230.01. If you want a little bit more margin of safety, let's say 15%, that is still an acceptable buy price of $236.17. And at 20%, you might want to wait a little bit at that point for the price to come down probably into that $210 to $220 range, which it very well could in the next few weeks and months here as the market kind of resets itself. However, I'm comfortable with the 10%, and I do think that Visa is a great bargain right now and a wonderful addition to any portfolio for both growth perspectives and dividends. Well, that wraps up today's video on Visa. Thank you for watching, and let me know what you think. Does anybody out there own Visa in their current portfolio? Do you have a very different opinion than mine of what the valuation should be? Please comment below and let me know. Also, don't forget to hit that like button and subscribe to the channel so you can get more great content just like this after you hit that notification bell, of course. And thank you for watching again, and happy investing.